Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Flowserve Corporation Annual Report. Flowserve Corporation offers a wide range of industrial flow management equipment and services to various industries worldwide. The company operates in two segments: the Flowserve Pumps Division, FPD, and the Flow Control Division, FCD. Under these divisions, Flowserve provides custom-engineered pumps, pre-configured industrial pumps, pump systems, mechanical seals, auxiliary systems, replacement parts, and related services. In addition to its equipment offerings, Flowserve also provides a range of equipment services, including installation, commissioning services, seal system spare parts, repairs, advanced diagnostics, re-rate and upgrade solutions, retrofit programs, and machining and asset management solutions. The company's flow control products include engineered-to-order and configured-to-order isolation valves, control valves, valve automation products, actuators, positioners, and switches. Flowserve also offers equipment maintenance services for flow control systems, including advanced diagnostics, repair, installation, commissioning, retrofit programs, and field machining capabilities. The company serves various industries, including oil and gas, power generation, chemical, water management, and general industries such as pharmaceuticals, mining, food and beverage, steel, and pulp and paper. Flowserve distributes its products through direct sales, distributors, and sales representatives. With a rich history dating back to 1790, Flowserve Corporation is headquartered in Irving, Texas, and operates globally across the United States, Canada, Mexico, Europe, the Middle East, Africa, and the Asia-Pacific. Flowserve Corp stock price has experienced a significant increase of over 52.68% in the past year, reaching an all-time high of $90.48. This substantial growth can be attributed to several key news events and positive developments that have taken place recently. One major factor contributing to this surge is Flowserve's strong financial performance. In February 2026, the company released its fourth quarter and full year 2025 results, which exceeded analyst forecasts. The adjusted earnings per share, EPS, of $1.11 was significantly higher than expected, and the company also initiated strong adjusted EPS guidance for 2026, projecting a 13% growth at the midpoint compared to 2025. Another significant event that fueled investor confidence is Flowserve's acquisition of Trillium Flow Technologies Valves Division in February 2026. This strategic move is expected to bolster Flowserve's margin outlook and enhance its opportunities in the nuclear and power markets. Additionally, Flowserve announced a 5% increase in its quarterly dividend in February 2026, raising it to $0.22 per share. This decision signals the company's confidence in its financial health and its commitment to returning value to shareholders. Furthermore, the divestiture of asbestos liabilities in October 2025 was seen as simplifying Flowserve's corporate structure and opening up new growth opportunities. The company's strong performance in nuclear and power generation markets throughout 2025 also acted as a key growth catalyst. Lastly, multiple analyst firms responded to Flowserve's performance by raising their price targets and reiterating buy or outperform ratings. Analysts cited the company's operational success, promising 2026 guidance and improved margin outlook as reasons for their optimistic sentiment. Flowserve Corporation market capitalization of $11 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Flowserve Corporation holds a significant advantage in their industry. Flowserve Corporation trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 5.14 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, acquisitions have played a significant role, with notable purchases such as Trillium Flow Technologies Valves Division and Greenray acquisition contributing to increased revenue. The expansion of market presence and strengthening of product portfolios have also contributed to growth. Additionally, amortizable intangible assets acquired through these deals are expected to contribute to revenue growth over time. On the decline side, factors such as declining asbestos liability exposure and warranty obligations have led to a decrease in revenue. Insurance accruals based on claim loss history and other relevant factors have also contributed to this trend. Regional sales trends show varying levels of growth and decline across different regions, with the United States and EMA experiencing increases, while Asia saw a significant decline. The company's international sales have been steadily increasing, representing approximately 62% of total sales in 2023, 64% in 2024, and 58% in 2025. This trend suggests that the company is expanding its global presence and contributing to revenue growth through international sales. The net income of Flowserve Corporation experienced fluctuations between 2022 and 2025. Initially, it increased by $147.2 million from 2022 to 2023 due to various factors. However, this trend was short-lived, as the net income decreased by $66.3 million from 2023 to 2024. The following year saw a significant increase of $268.1 million in net income, transforming it from a loss to a gain. The profit margins also underwent changes during this period. The gross profit margin increased by 1.9% from 31.5% to 33.4% between 2022 and 2023. Conversely, the operating income as a percentage of sales decreased from 10.2% in 2024 to 8.4% in 2025. The key drivers behind these changes were varied. The loss on sale of asbestos-related assets and the contribution to divest asbestos-related assets and liabilities negatively impacted net income in 2025. On the other hand, foreign currency translation adjustments led to a significant gain of $146.6 million in 2025. The company's financial performance indicates a positive trend in its operating cash flow. The data from page 54 reveals that the net cash flows provided by operating activities have been steadily increasing over the past 2 years. In 2024, the company generated $425.3 million in operating cash flow, and this figure has risen to $505.9 million in 2025. This consistent growth in operating cash flow is a positive sign for the company's financial health, indicating that it is generating sufficient funds from its core operations to meet its obligations and invest in future growth. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the debt level increased due to new credit agreements on page 32. This trend continued with the revolving credit facility increasing from $800 million to up to $1.2 billion on page 56. The long-term debt also saw an increase of $65,078 in 2025 compared to 2024. In terms of interest expenses, there was a notable increase of $21.7 million, 17.6%, in 2024 compared to 2023 on page 44. This trend continued with interest expense increasing from $-69.3 million in 2023 to $-66.9 million in 2024, and further increased by $8.4 million in 2025 on page 45. However, it's worth noting that the net change in interest paid was a positive $8,663 in 2025 compared to 2024 on page 76. Additionally, there were concerns about potential increases in interest expenses due to additional debt incurred for the MOGAS acquisition on page 89. Despite this, the overall trend suggests an increase in both debt level and interest expenses over the past few years. The performance of various segments and regions in 2025 was a mixed bag. On the positive side, the energy segment performed exceptionally well, driven by increased demand for products serving energy, chemicals, power generation, and industries. The general industries segment also saw significant growth, contributing to the overall success of the company. In addition to these strong performers, the chemical segment experienced a surge in demand, further boosting the company's revenue. Flowserve Pumps Division, FPD, was another standout, with increasing bookings and sales that exceeded expectations. However, not all regions fared equally well. The Asia-Pacific region struggled with decreased bookings and sales, while Europe also saw a decline in performance. The Middle East region experienced a drop in bookings, further contributing to the poor showing of these regions. On the other hand, North America and Africa emerged as top performers, with increased bookings and sales that drove growth for the company. These regions demonstrated resilience and adaptability in the face of market challenges, setting them apart from their counterparts in Asia-Pacific and Europe. The management is optimistic about the company's outlook, citing a strong focus on customer satisfaction as a key driver of their business strategy. They have implemented various initiatives to improve revenue recognition and reduce complexity through realignment programs. Financially, they are taking steps to mitigate risks through foreign currency economic hedging and liability-driven investing strategies. In terms of investment, the company is prioritizing long-term returns while minimizing cash contributions. Their pension plans are managed professionally with a focus on passive management through index funds. While litigation remains a risk, the company believes that their financial exposure will not be significantly impacted. Overall, the company's strategy appears to be centered around improving operational efficiency and reducing risks, which is expected to drive long-term growth and profitability. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company acquired MOGAS Industries, Inc., MOGAS Real Estate LLC, and MOGAS Systems and Consulting LLC, collectively known as MOGAS. However, it's worth noting that one acquisition attempt was terminated, which was the proposed purchase of Velen Inc. On the other hand, the company has also made several divestitures. One notable example is the sale of its pharmaceuticals business, which is no longer included within the chemical industry and is now part of general industries. The company has also divested its asbestos liabilities through the sale of BW/IP New Mexico, Inc., to Ajax Holdco LLC in December 2025. In addition to these transactions, the company has permanently ceased operations in Russia since March 2022. Furthermore, it has divested NAFOB and received $219 million in cash from the sale of its asbestos-related assets and liabilities in December 2025. These acquisitions and divestitures demonstrate the company's efforts to restructure and refocus its business operations. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. The records show that the company has indeed paid dividends to its shareholders, with a declared dividend per share of $0.84 in 2025. In addition to paying dividends, the company has also been actively buying back shares from the market. This strategy allows the company to reduce the number of outstanding shares and potentially boost earnings per share for existing investors. The records indicate that the company purchased a significant number of shares in 2025, with over 1 billion shares repurchased at a total cost of $254.9 million. Concerns about inventory buildup and supply chain disruption. There are several concerns regarding inventory buildup and supply chain disruption evident throughout the extracted summaries. On page 13, volatility in commodity prices is mentioned as a potential cause for customers to delay or cancel orders, which could impact manufacturing plant operations and capacity. Furthermore, on pages 15 and 18, tariff actions and price inflation have increased costs for raw materials, commodities, freight, and logistics, posing a risk of future supply chain disruptions. Additionally, page 104 highlights an increase in excess and obsolete reserve, indicating potential inventory buildup issues. The summaries also mention difficulties in enforcing agreements and collecting receivables through foreign legal systems, page 18, which could lead to business disruptions with customers. However, it's worth noting that some of these concerns are related to broader market or economic conditions rather than specific supply chain disruptions. That concludes the financial summary for Flowserve Corporation. Feel free to comment below and I will be happy to answer them when possible.